Hi, it's Monday, August 28th. I'm Greg Weldon, and this is a special edition of Weldon Live for our YouTube channel subscribers. We're also going to put this out over Twitter and try and draw some more people into our YouTube channel. Just to give you an idea of what we do every day, since we're only going to give you a sliver, today's Weldon Live includes all of this. Global macro, we break down the ECB's money supply and bank lending data, really interesting, particularly in bank lending. We look at the Italian business and consumer confidence survey, consumer more confident across the board, into the go-go growth zone of confidence in the Italian consumer. And then we look at really strong numbers from Sweden, retail sales and an increase in exports and a trade surplus. All of that ties into fixed income. We look at the Swedish bond market and the impact it has, in terms of the krona in relation to what's happening in the German bond market. So it's a really interesting kind of back around endgame story. But at the end of the day, if you think the euro is strong against the dollar, you ought to see the Swedish krona strong against the dollar. And foreign exchange, we actually go back to Mario Draghi and we take a full-blown look at the euro. We've been bullish the euro, we've been bullish the Polish zloty, and we've been short the US dollar index as trades in our trade lab for better part of 2 months. So these trades really gelling right now. The other big trade we have on is Chinese equity index ETFs on the long side, and that playing out very well today as the domestic indexes in Shanghai and Shenzhen's actually lagging, and like to see some catch up there and some catch up in the small cap area. But the benchmarks and the big names are definitely flying here, new year-to-date highs, and in some cases new 2-year highs. Metals is what we're going to discuss with you today. We've been asking for a while, got gold. We've been bullish literally since 1205. I called that low that day. Make some of these calls frequently. Once in a while, they turn out to be true. In this case, to us, it was a pretty straightforward. If 1205 is not the low, you got a problem in this market. And if it is, it's a really low-risk buying opportunity when the market was trading in 1212 and 1217. Energy, we also today looked at gasoline and what's going on with the hurricane. It's actually really interesting. So you can get all of that if you want to go subscribe to a free trial to our work, Weldon Live, daily research, one price. Very much value added, in my opinion. We call it the research that pays for itself. It's not an expense, it's an investment, and it pays dividends. Metals markets is what we're covering today for YouTube, and it's the bottom line. We've been bearish on the dollar all year. We've talked about the dot plot. We've talked about the shift in bond yield differentials. We have talked to we're blue in the face about this, and every step of the way, it's kind of been played out exactly the way we thought it would be. The only caveat to that was the last dip in gold, where gold was going down when the dollar was accelerating its decline to the downside. Frankly, I think Bitcoin has some of that. So these are some of the things I've discussed in recent interviews. If perhaps you've heard them out there in terms of podcasts and radio interviews that I do. But at the end of the day, where we stand right now, Fed's not going to meet their dot plot for next year. It's at 2%, 2.25%. The market's suggesting, it's a 100% chance of one more rate hike between now and the end of next year. And that's it. St. Louis Fed says no more rate hikes between now and the end of next year, and I might tend to side that way, depending on what happens in equities. But at the end of the day, commodities are breaking down. And in that sense, the dollar really doesn't need to be up here. The Fed doesn't need to be perhaps as aggressive as they have been. Inflation jumped on energy year over year and has receded. And it's not going to be rising, at least not in this calendar year, on a year-over-year basis to any degree that's going to cause concern for the Fed. And that probably extends out to the first half of next year. You'll actually get a negative, when you get last year's February energy prices involved. Maybe not. Depends what happens between now and then. At the end of the day, the dollar is suspect. The dollar has come off hard, and the dollar is likely to crack further. Here is what we love to watch in terms of linking it to monetary policy. This is a macro currency view that is really, in my mind, awesome. It is the dollar. It's simple, too. It's just the gold-adjusted value of the dollar index. What does that mean? It's a fancy way of saying dollar index divided by gold. It's that simple. It's a ratio spread. And it reveals the dollar against gold. And in this case, dollar index did not make a new high relative to gold when the dollar index itself did. That was glaring. The trade-weighted dollar, if you played it in here, also into this divergence dynamic. So a lot going on up there first of all, one of the reasons we turned bearish, but it was more about bond yield differentials and the likelihood that the Fed was no way going to be taking rates up to levels that they had suggested in a dot plot. And that's exactly how this played out. The dot plot, of course, in terms of the Fed funds futures, has flattened dramatically. That has pressured the dollar. More recently, the kind of the narrowing in the U.S. bond yield premium, although that's stalled a little bit right here, has been a factor in driving the dollar to the next level down. And in the case of the dollar against gold, it's breaking down on a medium-term basis, and it's breaking down on a long-term basis. You're about to take out the 2016 lows. These are huge. These are huge. This was the last big rally in the dollar. And then, of course, what you've seen since Donald Trump got elected. Donald Trump got elected in here. And, what happened? I mean, you're well below. You've almost symmetrically gone as high to the downside in the dollar as you went high on the upside in the dollar after Trump won. Okay? All the talk about 4% GDP growth and the Fed was going to have to take Fed funds to 2% quickly by the end of next year. Gone. And the breakdown is obvious. Hike, long-term breakdown, moving averages rolling over the whole 9 yards relative to the 2011 low, the debt ceiling / European debt crisis low. But at the end of the day, the secular decline, the dollar is still on. I mean, it's a double top off against the 2-year moving average, which is not violated, off of 2 Fed rate hikes. I mean, you can't set it up any better. I mean, we're not making this up. This is the way it plots out. I mean, it's pretty amazing. So that, to me, is interesting, especially when we look at the actual dollar index itself, which is testing the key level we thought would be violated. 85 has been our target the entire time. Okay? Unconfirmed new high, right at the 61% retracement of the entire decline. Crisis, A, B, C, dollar strength on Fed's going to be really hawkish. Not happening. Commodities breaking down. Fed's not going to be hiking. And you see the dollar doing what it's doing, rolling over here. And the flip side of that is the euro is strong because the European economy is a juggernaut. We've talked about this. Why we're long the Polish zlotys, why we're long Polish stocks, which are up huge. It's like a 17% trade for us because it's the second derivative of the German export juggernaut above 100 billion euro per month, something like 9 out of the last 12 months. It's some ridiculous number, 18 out of the last 20-something. And you see the breakdown happening in the dollar index. The flip side of that, the mirror image is gold. Here's your big bull move, 12 years, 1999, 2011, 4 years down, 1/3 of the increase. Okay, your first decline right at the 61% of retracement from the 2008 low right here. Okay, so that's your A. You kind of bead down into the zone between the two 50% Fibonacci's. First from the 1976 low, and second from the 1999 low. That's your zone. That was your low. How many days, if you're a regular WeldonLIVE customer, so we love doing this every day, we watched day in and day out and mapped out in candlestick charts how many upside reversals came from below this 50% retracement from the 1999 low. There was buying under there, and it was based on that price level, and it was uncanny. So then you get the rally, you get the retracement right to the 10-year moving average, exceeded the 61% retracement in gold just because the election, gold mining shares didn't, so other things didn't. They held their Fibonacci's, and now here you are, back above the 2-year, back above the 5-year, 10 years reaccelerating to the upside. You got a positive rate of change after the worst 3-year period in gold since the early 80s, since the collapse in gold. And here's your breakout. 2 years about to be above the 5-year. You're about to have all the moving averages in alignment. You're looking at violating the downtrend line going back to the 2011 high. Maybe it's too perfect. I said on a recent podcast, my fear is this is too obvious. It's too perfect, But the bottom line is you take out 1377, and here's your breakout, and you're actually higher. Obviously, today you're up around 1310. The bottom line is above 1377, there is air, baby, and this setup is bull market, correction, bull market. We really like gold here. We're also long platinum. Now, in terms of our trade lab, these are just the trades we have now. All of them at least a month. Long the euro, made a new high this morning. Long the Polish stock index, ETF, it's a 2-year high on Friday. Long the Chinese equities, 2-year high this morning. And long gold and platinum breaking out. Get in on this. What's our next strategy call? Well, don't miss it. It could be tomorrow. So sign up now. We invite you to sign up for a free trial to our work. I can't say it enough. I'm a pretty humble guy, but I bust hump to provide value and basically to provide you research that pays for itself. That's it. Have a great evening. We're back at you sometime in the next week or two.